We have Jerry here from Pacific Financial Planners, who knows pretty much everything there is to know about the income and about the market today. So thank you for joining us.
Well, thank you for having me again, Lisa. Appreciate being here.
And we were just talking off camera, you know, we're trying to make sense of all of the volatility that's going on. You know, are we going to go into a recession? Are we not? I mean, there's just so many different opinions out there. Are you hearing the same thing from your clients?
Well, you know, I'm trying to take care of my clients, so I get my information from other sources. But yeah, I do think that this recession fear is warranted. I actually kind of think it'll be very interesting to see in a few weeks where they come out with the gross domestic product, the GDP.
Right.
The textbook definition of a recession is 2 quarters in a row of negative GDP.
Right.
The first quarter, 2022, was negative, like a 1.6% negative print. And the Atlanta Fed is already saying they expect 0 for the second quarter, and I believe that too.
Okay.
And if that happens, that means we're in a recession today.
Okay. And then what would that mean for consumers and our residents? What are some things they should be careful about?
Well, again, the reason we're in this recession, as everybody knows, is because of the costs that have gone through the roof, the inflation costs, your gas prices. You know, I don't need to tell any of the listeners, they know what's going on, food prices.
Right.
And what we're seeing is when you're spending more money for certain items, you have less money to spend for your discretionary items, like, you know, things that would drive the economy in a broader sense.
Right.
If that's not happening, then it starts to collapse the economy and you get a recession. The big scare is if we have stagflation. If this inflation stays high and interest rates stay high, and then you have a recession for workers, not necessarily the people in the community, and they start losing their jobs, that's when they'll really feel it. But
Exactly.
our residents have some concerns as well, especially trying to protect their capital in these volatile environments.
Right. Well, let's take a look at one of your charts to kind of understand, you know, what is actually going on. So you have this here, it says 10-year U.S. Treasury interest rates have doubled since January 1st. So what are we looking at?
Yeah, you're just looking at the rate of the 10-year Treasury. Now, what does that mean? The 10-year Treasury is the base cost of money. And so if your money cost to borrow have doubled, then that means, like for housing, let's just look at mortgage rates, which base off of this 10-year Treasury. It was 3% at the beginning of the year to get a 30-year mortgage fixed, conventional, and now it's over 6%.
Wow.
So average house in Orange County, not here in the Village, is $1 million. If you borrowed $1 million, it would cost you $30,000 in interest. Now it's $60,000. So it's not up 3%, it's up 100% your cost of money. So it, therefore, again, it goes to that discretionary spending. If you've got to spend now $60,000 just for the loan on your mortgage, guess what you're not doing? You're not buying the vacations. You're not buying as many, you know, discretionary goods and services.
Right.
That collapses the economy. We're already seeing it. Housing prices are starting to slow down. We're going to see that go more.
Yeah.
And that's a problem for people trying to get in. Now, if you've had a mortgage, you know, knock on wood and thank your lucky stars that, you know, you have a cheaper rate.
Exactly, exactly. But still, we're looking at, like you mentioned, gas prices are very high, as well as products are also very high, and that doesn't seem to be decreasing at all. So people are still shelling out much more than they had anticipated.
Well, Lisa, unfortunately, not only decreasing, as we were just talking about off camera, is that as long as the producer prices, the cost to the people who manufacture and sell us the goods, is going at a higher rate, about 11%, and we're at 9% to the consumers,
right,
they're going to pass those costs on to the consumers. I don't see those costs declining until we are in a full-blown recession. But that's probably what it's going to take to get out of it. But investors have some opportunities now, okay, because the markets have been very volatile, to do two main things. One is just make sure you do a needs analysis, an income analysis of what you really need from all your sources of income. And then secondly, to do a risk analysis. Because the stock market is down somewhere between 25 and 35%, depending on which major market indice you look at. And some people are doing even worse than that. It's not too late to kind of look at your portfolios and make sure you're protected.
So let's talk about investments. So of course, people like to receive income from their investments, like dividends and things like that. What are some things you would say to people?
Well, again, as you mentioned at the start, is I'm an income specialist, which is quite a bit different than most of the industry. Most of the industry, and it's not through their own fault. They got in like I did when I was young, and people want to grow their money and grow, and you save for retirement. But our listeners, when you start to, when you retire, you need that income, as you said.
Right.
So there's a world of income out there. There's banks, bonds, insurance companies, there's convertible bonds, there's preferred stocks, which are safer than regular stocks. There's something called closed-end funds, REITs, people have heard of real estate investment trusts, business development companies. But one of the safest things to start looking at is short-term bonds. They're paying pretty good. I mean, we're starting to look at some corporate bonds that are 12 to 18 months in the 3 to 4% range by good companies like IBM and AT&T and Bank of America. That I think those companies will be around in 12 to 18 months.
Well, it seems like that they've been able to, withstand the turmoil that's been going on for so long. Now let's take a look at your next slide, and what are we looking at on this particular one?
Well, that's the market. That's the S&P 500, and you can see it's down 24% since January 1st. But if you look on the far right side, where it was like 4,200, and then all of a sudden now it's down well below that. We had, in the last couple of weeks, we had a 12-day or a 6-day stint where we went down 12%. Get those numbers right. 6 days down 12%. We're talking about a $40 trillion stock market that dropped about $5 trillion of net worth in just a few days. That's the repricing of the markets due to this interest rate adjustment, where rates are going higher because of trying to combat inflation. So this is where I'm talking about needing a risk analysis. Far too many seniors here in this community have far too much exposure to the stock market, things like this S&P 500 index and the NASDAQ, which is the other chart I had.
Some would argue that if, people want to pull all their money out, right? It's like, oh, they're scared to death. They just want to pull it out and put it in cash. What's wrong with that?
Well, it's an irrational decision. You need to make decisions based on sound judgment. And it's definitely possible that you should reduce exposure, but which things should you sell? Not everything goes down equally. There are things that work, that go up. I mean, for example, for most of this year, if energy prices, you're seeing the gas and oil prices go up, that hasn't been bad at all. Other things like high tech, because the price to earnings ratio were so wild, and that repricing of higher interest rates caused that sector to collapse. But you can't just willy-nilly just say, well, let's just sell everything.
Right.
You should really have a plan for participation in the markets, but you also need to include protection. I call it the 3 Ps. A plan for participation and protection. That's really the only way to go. So again, if you're working with an advisor, great, always get a second opinion. It's free. Talk to a couple people. Use your own judgment after having an intelligent conversation with people who are experts in the field, and then make your own choice. Maybe I should sell everything, or maybe I should, maybe sell part of it, or maybe you're in good shape too. I mean, some people are.
Yeah, and it sounds like you would be able to guide them one way or the other, which is excellent. Let's talk a little about some of the forums that you've been having. You're still doing it for pretty much the rest of the year. How have they been so far?
Good. The COVID scare at the during the holidays, kind of put us back on the back burner. But since then, started off with maybe 20 people. Now we're back up to around 40 people, which is about what we're getting normally.
Okay.
And the thing is we cover various topics. Will your money last is the next one. We're going to talk about the risk and needs analysis.
Okay.
And that's really important to do. And so what are those various instruments for income, and how do they work, and if they're applicable to the people. The other part about it is the people who attend are all community residents, and they have opinions as well. So it's a shared forum of shared ideas. It's not just one person, giving a lecture the entire time. It is a collaborative effect. So people that have a lot of experience in investing, for people who are novice, you can get all your questions answered there in a very no risk, very anonymous type environment.
That is a great way to go, because like you said, some people are better off than others, and maybe those that aren't as well off could learn from those that are.
Absolutely.
So That's a nice way to do it, because then the expert, being you, is there going, well, let me tell you what I would do in my situation.
Right.
Right.
When you become a senior, you become a library of knowledge. And that's what we have, is a bunch of libraries of knowledge all collaboratively helping each other.
I love it. And then, of course, the next one is going to be shortly here in the next week or so. And that's awesome. And that's every last Tuesday of the month from 3 to 5 p.m. in Clubhouse 5, Room 1. And it is free to attend.
That's correct. Thank you, Lisa.
Excellent, excellent. Anything else I might have missed?
No, you've covered it all. I mean, obviously, the biggest thing is just to, it doesn't hurt. It's your money. You only get one chance at retirement. You've got to make your money last. It's free to get a second opinion. It's a problem when you don't have money. It's a problem when you do. And when you do have money, you want to get that, make sure it's going to last. Get a second opinion, get a third opinion, and then make your own decision.
All right, perfect. Thank you again for the information.
Thank you, Lisa.
If you want more information about everything that we've just discussed, including investments as well as the forums, you can always go to safeincometoday.com. We'll be right back.